Hi, I'm Craig Cecilio, the CEO and founder of Diversity Fund, a fintech platform that serves the everyday investor. This is my YouTube series, where we'll be talking about training topics such as fintech, the wealth creation space, and the capital markets industry. If you like these topics, please hit the subscribe button. So today we're going to talk about AI and robo-advising, investing, with algorithms and artificial intelligence, and how does that affect things? Well, another exciting topic, and I love this topic. And you can tell I'm a little bit optimistic about technology and where I'm going to go with this. However, I'm big into data, and so I'll talk a little bit about data, which is some of the things that give us empirical information of what is happening today. And let me say it's today. This is very new. This stuff AI has been around, I think, since the 80s, but really in how we're applying it, the robo-advisors has been really new this last cycle, or this current cycle, whichever you want to say. Some people think the cycle is going to change again, but that's another conversation. Is we've had a lot of platforms come out, such as Betterment, Wealthfront. You see Goldman Sachs has Marcus, and you have all these robo-advisor tools that are out there. And these tools, I believe, is just the beginning. It's kind of fantastic. You have major hedge funds using intelligence to make decisions. And now you have these robo-advisors and these platforms that are offering these services to everybody. Now you got to say, okay, do they work, or what's your opinion? If they, do they work for myself? Do they work for somebody else? Well, what happens with wealth planning is you look at the end of the day, who gets the best service? The best service is usually reserved for a special division. It's like if I go to Wells Fargo, let's say, and I want to meet with a banker, there's always a private banker in the back, right? Is that private banker going to meet with me? Well, I have actually been there before and talked to a private banker and had a private banker shut the door on me and say, hey, you don't have enough money for me to service you. And those exact words. I'm like, what? Are you kidding me? And I kind of got the door shut in my face. Well, I only work with people with this much net worth. And so you're looking at that. So the best advisors only work with people who have a certain amount of money, at least $1 million plus. And we have a case here in our company where we are talking about our private banker. Wells Fargo is an example because we use them, or we're still using them right now. Say anything what we're going to do in the future here. And they said, hey, our business revenue was close to, I don't mind disclosing this out loud, it's close to 10 million last year. And they say, we only work with customers that have businesses that have greater than 10 million. We're like in the nines or something. And they said, wait, I can't get good service unless we're at another level as a business. I mean, what is that? So that's where these robo-advisors come in. It's offering some tools for people who don't fit the criteria to get the best service. And the data is showing that the people who use a robo-advisor, who trade on their own or do financial plan on their own, or have I want to be politically correct, but I'll be straight, a lower tier advisor. So that's the data is showing that using a robo-advisor outperforms individual decision-making and lower tier advisors. However, it is a little bit less than that higher tier advisor who takes on those $10 million plus clients or $1 million plus clients. The data shows that they actually get higher returns at the end of the day over a portfolio. And that's what the data is showing. Some of the things that are not positive about the robo-advisor, it's new, right? There's going to be mistakes. The way it works, data in, data out. So there is still components where they're not flexible, that they're not making decisions that are stuck in a box. They're based on certain theories that could be just maybe a little bit outdated for this point in time, not taking into consideration all these other circumstances around being nimble, being quick. And there is sometimes an emotional component to this too, and that has to factor in. However, I believe with time, and which is data in, more inputs and more scenarios and more testing, that these algorithms are going to learn and get smarter and smarter and make decisions. So talk to me in 10 years from now on how that performance is. But today we have to look at the data. So look at the data as people who use robo-advisors, people who get that higher tier advisor, maybe the mid-tier advisors, and look how the performance, how it goes. And it's got to run also through a couple of market cycles. This last 10 years, we've had kind of a bull run. So, the bull market's not really, it's difficult to do things, to make decisions. So you want to see it kind of go up and down a few times really to get that data in to really see how it performs. and down periods as well to see how it stacks against the different advisors in different levels. So again, this is a great topic to talk about. There's so much to go into because we could dive into data, we could dive into the way the legacy or traditional world operates. We talk about how institutions and high net worth individuals get the better service than everybody else, but the robo-advisors created to give everyone at least a minimum amount of guidance to do things where people otherwise weren't served before. So it's a great start. The intention's there. It's only going to get better. So this is a great topic to talk about. I'd love to talk more about these types of topics. If you'd like to learn more about this, just please subscribe to my YouTube channel. We'll be talking about this and various topics in the future.